RTX stock is up almost 10% over the last few days after Q3 earnings came out. So obviously investors and the stock market really liked what they heard and saw from that earnings report. So in this video, I'm going to kind of peel away that earnings report, tell you what was good, what was bad from it overall. RTX is one of my largest positions in my portfolio. In fact, it's one of my top 3 positions. My background is in accounting and finance, and I mostly worked in the government contracting space, including at RTX. So I feel like I have a really good understanding of the business and the industry just overall. In fact, a few weeks ago, I came out with a video and said RTX was a buy. If you want to go check that video out, I'll kind of put a link up here somewhere and you can click on it. Also put a link in the description below if you want to go check it out. I do a deep dive on valuation, kind of the segments of the business and all that good stuff on there. So definitely go check that out. But without further ado, let's just jump right into this video. So real quick to recap RTX, it's a combination of Raytheon and United Technologies, which merged back in 2020. Currently, it has 3 business segments. You have Collins Aerospace, which focuses on the aerospace area. Obviously, we have Pratt & Whitney, which focuses on engines for fighter jets, Boeing, and Airbus. Then you have the Raytheon business, which is divided into 2 different segments itself, which is like missiles, warfare, and then also R&IS, which is kind of in the space arena. So R&IS is actually the area where I worked for a period of time. So the Pratt & Whitney segment of the business has been in the news on a negative front over the last couple of months. So they discovered that there was some metal powder coating that was defective on some of the engines. And they announced that there was going to be a $3 billion impairment because they're going to force all out of their customers to ground the planes so that they can take a look at that powder coating and see if they need to make any changes or even just fix the issue. However, the Pratt & Whitney segment of the business is actually a big positive in the quarter. They posted a $6.3 billion revenue for the quarter. It was up 18% year over year. The F-135 engines, which go into the Lockheed Martin fighter planes, they increased their production by 7%, which is phenomenal. Another highlight during the quarter was their Collins Aerospace business. The adjusted organic sales was up around 17%, with the commercial aftermarket up 30%. In addition, the CEO, Greg Hayes, said this. He said the historical demand across our commercial, aerospace, and defensive businesses drove 12% organic sales growth during the third quarter and led to another record backlog of $190 billion. We are on track to deliver on our update financial commitments for 2023, including our increased sales and free cash flow outlook, as well as the tightened range for adjusted EPS of $4.98 to $5.02 per share. Something else that came up during the earnings call, which was really interesting, was the board approved a $10 billion accelerated share repurchase program commencing immediately. And what's interesting about that, first off, with all issues with the engines on the Pratt & Whitney side, a lot of people were wondering what that was going to do to free cash flow, and then also what was going to be the capital return to shareholders through 2025, because the company has been harping on that they will return between $33 and $35 billion to shareholders through 2025, and actually increasing that to $36 to $37 billion through 2025. So that is a really good sign, at least to me, that management feels very confident going into next year that free cash flow is still going to, or at least be on a good trajectory of getting to $9 billion by 2025. And keep in mind, this year, it's supposed to be around $4.8 billion. So that's almost a double free cash flow number over the next couple of years. Now, what I don't necessarily like is the company is going to use short and long-term debt to furnish the buyback. So they're not using free cash flow now or cash to purchase those shares back. They're going to use debt in order to do so. The only positive out of it, I guess you could say, is that Actually, two things. So management said that they're going to focus on deleveraging the balance sheet in 2024. So that means they're going to start paying down their debt, which is good. They need to do that. Their debt situation isn't terrible right now by any means. I mean, their debt to equity is actually very, very reasonable. But I don't really like when companies tend to buy back shares using debt. But they did announce that their cybersecurity business, which is worth over $1 billion. In fact, they're going to sell that for $1.3 billion. So at least that will furnish about 10% of those buybacks that are going to be going on. But I'm also glad that they're going to be deleveraging the balance sheet in 2024. That's a good indicator that they're still on track for that $9 billion free cash flow number in 2025. Earlier in the video, we mentioned a $190 billion backlog that it's grown to for the company, which is absolutely tremendous. So they're going to be around $75 to $80 billion in revenue this year. So if you think about it, that's almost 2.5 years worth of revenue going out into the future, which is, again, absolutely tremendous. And about 60% of that is commercial and about 40% is from the government contracting space. And one of the reasons why I like RTX compared to some of their competitors, I love Lockheed Martin as well too, but Lockheed primarily is actually, well, it's the largest government contractor in the entire world, but primarily all of their revenue comes from government contracting, which there are some caveats and some issues with that, where RTX has a good mix of commercial and government. And in fact, 60% is commercial, 40% is government. So I like that spacing overall. Not only that, but the company announced they had $22 billion in new orders in Q3. That is extremely impressive. In addition, their book-to-bill ratio actually dropped during the quarter. So in Q2, it was like around 1.34. At Q3, it was at 1.19. So a book-to-bill ratio essentially tells you how much the company is taking in bookings versus what they're actually billing. So bookings are new orders. When they get an award from the government, or they get a signed contract with Boeing or whatever, that is a booking. What you like to see from an investor's point of view is that book-to-bill ratio, at least from my standpoint, is just over 1, because that's telling you, hey, their bookings are a little higher than their billings. What you don't want to see is all of a sudden that number get to be too big or too high, because the book-to-bill ratio at 1.34, 1.35 can be an indicator that the company's bookings are actually slowing down compared to their billings overall. So that's just kind of a general statement, but I do like where the book-to-bill ratios at the end of the third quarter. So what are my current thoughts on RTX right now after reading the Q3 earnings, listening to their Q3 call? And it's basically the same place I was before. I had a fair valuation of the stock around $95. Again, if you want to go understand how I got to that $95, the link to that video is down below. But it really doesn't change anything from what I thought. I think it is good to hear that they still believe that $9 billion free cash flow number is on pace for 2025. Now, my valuation does not include the accelerated buybacks, just because I'm trying to be conservative. You never know when something might pop up negatively in the future. So again, I just like to be conservative. And I also do not take into effect the dividend as well, which it's over 2% right now, which is one of the best in that space. Something else to mention too is that recently the White House has approved $40 billion going to Ukraine. So I would think that some of that money should be flowing down to RTX and some other government contractors as well. So that should help revenue in the future. Now, there usually is a big time between when that gets approved and actually goes into action, and when these companies actually see that money. So it's probably not going to be in 2023. Might be in 2024. We may probably see that. But overall, I think Raytheon RTX is in a really good spot overall. I think it's a really good indicator, at least self-confidence for me, that management believes that free cash flow is still going to be good at the $9 billion number in 2025. They increased the capital return to shareholders, which is phenomenal. I don't like them using debt to furnish their buyback. So I want to see that they're going to deleverage that balance sheet like they said in 2024. Good that they're selling off their cybersecurity business to at least attain about $1.3 billion. So overall, Really happy on where it's at. I'm going to continue holding my shares. The story is still where I thought it was at, even better now, in my personal opinion. So those are my thoughts, but I'd love to hear from you guys. What do you think about RTX right now? Do you think that fair value of $95 makes sense? What other companies do you like in the government contracting space? Love to hear from you down in the comments below. If you haven't already, please like the video. It really helps out the channel a lot. I personally appreciate it. If you like this type of content, I encourage you to subscribe to my channel. I talk about stocks, the stock market, all that kind of fun stuff. So thanks again for watching. Appreciate it. Catch you on the other side. Take care and God bless.